Again, I know a lot of people in the room we've met before. For those of you who don't know me, I'm Martin Malinow. I'm the founder and CEO of Parametric Climate. We're an end-to-end advisory, distribution, and analytics firm focused on parametric climate and weather risk. I'm sitting up here along with an esteemed group of experts to moderate the second panel entitled The Parametric ILS Investment Opportunity. Great first panel. It's always tough to follow Lorenzo Volpi, my old friend, who raises the bar on everybody who comes up and tries to do this. So great job, Lorenzo, on the first panel and the panelists as well. First off, I believe in all the years that Artemis has been putting on this conference, this is the first panel actually dedicated to parametric opportunities. Is that right, Steve? Somewhere here in the room? He's left. For my part, I've been working in what is now called the parametric market since 1998, so pretty long time. About a year after two traders crawled out of the primordial goo of the early environmental markets, sort of stood upright on their hind legs, picked up phones, and actually traded the first heating degree day swap in, again, 1997, which was indexed to Madison, Wisconsin. And that was kind of the day zero event of the parametric market getting started, which really in the early days was weather. Back then, people like me would just tell others that we worked in the weather market. The term parametric really didn't get a lot of mention at that point. We accomplished a lot in those early years. I mean, Sandeep, you were there early on. Standardization of contracts and data sets, working through regulatory frameworks and accounting treatments, the development of early pricing models, a few notable bankruptcies. And we believe that the market would continue to grow because it made sort of quote unquote all the sense in the world. And in fact, back in the 90s in the gleaming office towers of Houston, many people were convinced that weather trading was going to be right up there with rates and with FX, just given how much and what percentage of the global economy was impacted by variable weather. While that's kind of not yet come to pass, the weather derivatives market has continued to grow organically over the years, sort of blissfully unaware that it was the ground floor of something much, much bigger and much more impactful, which is the parametric market. And while the cat bond market was just kicking off in the late 1990s, we actually saw a few early weather bond issuances. A few people in the room might remember those. There was Koch Industries' Kelvin bond. There was Enron's Winners bond. Given the issuers, they were designed more as trades against bondholders than sort of creating new capacity to handle peak exposures. And without that objective of sort of solving a systemic capacity challenge, bonds like those were sort of one and done. But some of the early cat bonds, as we know, were also parametric, which helped create eventual investor comfort with indemnity-linked bonds, but also introduced a broader set of investors and issuers to the concept of parametric risk transfer. So, obviously parametric cat bonds are still, of course, being issued, and there's a vibrant market for ILWs. So we've also seen exchanges create futures over the years, some successful and enduring, like the Chicago Mercantile Exchange's temperature complex, some less successful, like the hurricane contracts that were out probably about 15 or 18 years ago. Steve, you mentioned the life contracts, which I completely forgot about and didn't know you were involved in sort of the early pricing models there, but life also had I think it was a daily average temperature contract back in the early 2000s as well. So, the exchanges have tried to do their share and come in and provide liquidity, price discovery, credit disintermediation. As the participants also grew beyond those pioneering energy companies, we started to see more reinsurers, more multi-strat hedge funds, commodity trading houses, and of course, dedicated ILS funds. So by the early 2000s, the weather market was starting to pick up steam. It had become global. There was a smattering of activity across various industry verticals, some of it large, like some of you may remember the Dutch construction frost day program. There were emerging market farmer weather insurance programs in Africa and in India. Yet the bulk of the protection parametrically was really emanating from a single vertical, which was global energy. And on the Nat Cat side, there was an enduring soft market for a good long while, and save for several notable parametric bonds, little risk was transferred via parametric insurance at the time. And look, we had a sort of a catalyst event in 2017 after Harvey, Irma, and Maria, when clear protection gaps were exposed due to the intensity and rapid succession of the storms, namely the need for objective, fast-paced solutions at a time when claims adjusters were overwhelmed and the storm impacted needed financial relief. And the solution was parametric products. And parametric NatCat products then began to proliferate. First as simple sort of blunt object, cat and shape type products, mainly indexed to hurricanes, but eventually evolving in line with underlying data sets and faster computing to provide more precise, hyper-local payouts with less basis risk. It was a true alternative product to traditional indemnity insurance. Parametric NatCat volumes then sort of exploded in the last kind of 5 to 6 years, buoyed by the return of hard market conditions, supporting new underlying perils beyond hurricanes. Many non-weather driven, like earthquake, wildfire, which is sort of a hybrid peril between weather and non-weather, and now cyber. We've also seen innovative programs for crop yield, footfall, economic activity, airline delays, and of course, pandemics. So in early 2022, we had another catalyzing event in the energy markets, right, where the geopolitical situation in Eastern Europe literally blew up the European energy markets. It blew up both the national energy companies and sort of, as we joke, the soon-to-be nationalized energy companies that basically went insolvent in the face of what was going on with the supply situation of gas from Russia to Europe. And they all came in literally in lockstep to buy billions of dollars of limit of cold side protection because they couldn't tolerate a cold winter in 21, 22. So, that brings us to the present. Here we are in early 2025. We're trying to divine what's over the horizon and is yet unseeable for parametric products. Will there be a separate parametric market, or do various risks like non-cat weather or NatCat or cyber simply require parametric execution as an alternative to traditional indemnity execution? So what's the opportunity for alternative capital? That's what we're here to answer today. In a broad sense, and specifically ILS capital, in supporting risk transfer for these products. What's needed, what's currently missing, how do we fill the gaps that create a highly functional market to deliver both value-added risk transfer and attractive returns, to make parametric risk both insurable and investable. So, our expert panel today will help light the way. So let me introduce them quickly and commence the discussion. To my left, Tanguy Touffut, who's the founder and CEO of Descartes Underwriting. Oris Ramseier, two down, sorry, looking at the list here, who's the CEO and the CIO, I believe, of 12 Capital. Sandra DeSilva, a founder and the CEO of Mythen. And then last but never least, Sandeep Ramachandran, who is a founder of Pier 61 Partners and portfolio manager there. So to really commence things, we wanted to cover a few basics because this is really the first parametric panel. And Sandeep, I'll start with you. It would be really useful, I think, to spend a few minutes just talking about what exactly is a parametric product.
Yeah, thanks, Marty, and appreciate the walk down history lane there with the evolution of these products over time. But I've been doing these products in different roles as a risk taker, underwriter, trader over the years. And the thing that really strikes me every time is when you talk to different people about what a parametric is, you never get the same answer. Everyone has a different opinion on what a parametric product is. Most people here would, given the insurance and property cat nature of the risk that we're involved in, would think, as Marty referenced earlier, a parametric product is perhaps a cat in a box or a cat in a circle where you have a hurricane with various payouts at different intensities, perhaps an earthquake structure. And while those all do fall under the category, I think it's just too narrow focus when you really think about what parametric product is. So when I take a step back, I really say, look, anything that has an observable and independently verifiable index can effectively be a parametric product. And sure, these hurricane products can, but so can a lot of other products. Marty was talking about a lot of these so-called non-cat parametric products, things that depend on temperature, on rainfall, and it affects a number of different verticals, whether you talk about the energy sector, as Marty was referencing, the agriculture sector. Clearly, it impacts the insurance sector, and we've seen that with the hurricanes that we've had, the earthquakes and wildfires. We fortunately haven't had too many big earthquakes recently, but clearly with the wildfires. So we've had a lot of severe convective storms over the last couple of years. So there are a variety of products, but the key thing is if you can quantify this, have this measured by an independent agency, typically it's the National Weather Service or NOAA or some type of agency that can report independent data, I think that really is what qualifies it as a parametric product. And I think there are a lot of non-cat products which actually help diversify a lot of the peak cat peril risks, whether it's temperature, rainfall, a drought in either the US Midwest, in other parts of the world, can have a big impact on the agriculture output. And eventually, I think there's a lot of risk transfer products that can really be used by the ILS community. So maybe I'll stop with that and see if anyone else
Sandra?
wants to add something.
So I think traditionally there's been a lot of the parametrics in the ILS market on cat bonds, and so what we're doing is actually I think there's room for bringing the parametric products down to more of that retail commercial level as well. So I'm not sure if this is working. So there's a lot of opportunity now where parametric is going down to more of that retail, commercial, high net worth, residential space where there is, or agriculture, there's businesses that are really affected that can use parametric products as an alternative to indemnifying their risk.
Mm-hmm. Tanguy, as far as sort of comparing indemnity to parametric products as far as loss adjustment, when sort of that loss adjustment occurs, it's an interesting aspect.
Yeah, clearly the definition given by Sandeep is very relevant, but mainly for, I would say, the insurers. If we look at the insured, it's true that they buy parametric insurance because it's very transparent. And there was an inflation in terms of the wordings over the last few years, following, for example, COVID-19. It's much more efficient in terms of the claim payment. So it's a matter of days rather than a matter of years for some corporate businesses. It's, of course, bespoke. So this is something that is very tailored to the client needs. So there are plenty of big advantages for parametric insurance products that explain why it's becoming more and more popular in the market. And it's true that 20 years ago, people thought that it would be only applicable to quake and, for example, hurricane. And we see that now all natural perils, from severe convective storms to wildfire, can be covered by an insurance, by a parametric insurance product.
And Urs, the products can be contracted either as insurance or derivatives. It'd be interesting to get a quick take from you as to why somebody would use a derivative versus potentially wanting insurance, economic interest, non-economic interest, things like that, flexibility.
I mean, from an investor perspective, we're completely indifferent whether it's an insurance or it's a financial instrument. It doesn't really matter. So we can suit the need of the cedent and the protection buyer.
Okay. And really a great way to think about parametric products is there is an underlying index, and that index needs to be meaningful to the buyer, right? It needs to proxy something. And there's an overlying financial structure. Those are the financial terms. And there's 7 or 8 parameters that sort of make up a contract that need to be spelled out in every contract. But very simple way of thinking about it is you are really doing one of 2 things with a parametric product. You're either buying a call option or excess protection on a bad event. So think about a grower in Florida with freeze conditions making the oranges fall off the trees and be unusable, right? That's a bad event, and they want excess protection on the bad event. Or you can have a put option or shortfall protection on a good event. And what could be a good event? Well, for a utility who likes it to be cold in the winter and warmer in the summer, so people use their heating and air conditioning. So heating degree day and cooling degree days are sort of good things for those utilities, and they're trying to buy shortfall protection or put options against those. And really, everything done in parametrics is going to fall into one of those 2 categories. So just continuing on and really starting with you, Sandeep, here, just thinking about the current market and what it looks like, thinking about what are the perils on the non-cat side? What are sort of the peak perils? You mentioned some of them. And what are some of the emerging perils, the non-peak perils that are becoming more interesting to protection buyers?
Sure. I guess when you really consider the non-cat parametric products, historically, as Marty said, I think the energy sector was the biggest participant. It was easiest for them to quantify their exposure. Energy demand, if you're an electric company or a utility, you can very easily map your electricity demand to what the temperatures are. So there was a real proliferation of these temperature-related contracts, HDDs, CDDs. I think Marty mentioned some of these contracts actually got on the CME. They were relatively standardized. So that's sort of what we would call typically the peak non-cat products. I mean, it's not quite as large as sort of the peak products on the cat side, but there's a lot of demand from electric utilities, from other natural gas producers for these type of temperature products. And predominantly, the demand for these tends to be on the warm side, at least in the winter. So if you have a warm winter, most of these energy companies are producing less product for residential customers to heat their houses, for example. So temperature-related products are definitely one of the key elements, and that is focused on the energy vertical. But if you really think about the agriculture segment, they're really more exposed to rainfall. Having a drought, an extended drought, is a big issue for them, and it can have a huge impact on what the agriculture yield or output would be. But it's not quite as simple as that, because you could have excess rain, it could damage your crop. So it actually becomes a very nuanced approach that needs to be taken. But the peak products include these temperature, rainfall products, as well as one of the key things I think that has been very helpful in these spaces is, as opposed to purely looking at what the impact is on the demand in terms of temperature or rainfall, is also looking at it in terms of revenue. So really, if I'm a farmer, I care about not how much corn I'm producing, but what price am I selling it at? So what's my revenue? So it's really the product of the actual yield and the price that they sell it. So these become revenue products, or the market likes to come up with a fancier term. They call it quantos, but essentially it's a combination of either some kind of temperature or weather variable combined with a price variable. So those are essentially the key products that the non-cat weather markets sort of focus on. But then as we've gotten to a lot of newer areas in the energy space, in the renewable side in particular, with wind generation picking up, you have a lot more solar generation picking up, you have products that are based on wind speed, for example, and as opposed to most people who look at excess wind speed, this is actually lack of wind typically. So if the wind's not blowing enough, you're generating less electricity. A lot of these electric generators that are sort of, or wind-based electric generators are looking at a 5-10 year horizon, and they're looking to finance their projects on that basis. And guess what? If it doesn't blow as much, the wind, there can be in a significant hole. So there has been a significant increase in terms of the number of products that are offered to these types of markets. And I think there are a lot of other variables, for example, snowfall. I mean, we just had a little bit of snow for those who were in New York earlier this week, but it seems to be snowing less and less frequently. But if you're up on a ski slope, the season seems to be shrinking, so you can have someone as simple as a ski operator saying, hey, look, if it doesn't snow enough and for long enough duration, I want to get paid out. So you have these types of non-peak risks, which can be structured very easily when you really look at the variables that you have at your disposal. But to date, the key peak risks, if you want to call it that, Marty, I guess, on the non-cat weather side have been focused on temperature and rainfall. So.
Yeah, and I'll jump in with just one little bit of information because it's kind of entertaining. I mean, we get requests all the time from multiple players in multiple verticals, and they wind up asking for index types or index transformations of the underlying weather peril that are quite entertaining to be named. So as only the Germans can do, there is a word for a wind drought or a protracted wind drought when Germany obviously has a lot of wind energy, and when the wind doesn't blow, it causes quite a bit of problem and price spiking. So that's called a Dunkelflaut. Don't try to spell it, but there's an umlaut in the middle of it. We've done for chemical producers for agriculture, infection days for fungicides, skinny cow indexes, turkey death days, jacket degree days, construction delivery date. So, the application is in the name, right? It's being applied to an underlying pain point or challenge for the protection buyer, and then they're buying a very generally simple overlying product against it. Now, Tanguy, on the Nat Cat side, which has really been surging, it'd be great to hear more about the peak products as well as sort of the emerging perils that Descartes are working on.
Sure. So clearly, we see a big uptake in terms of parametric products, and it's, I think, mainly linked to the new technologies we can use. So typically, we have more and more data sources from satellite imagery, from radars, from sonars, that we can use through AI, or I would say innovative algorithms, to be able to get rid of the basis risk, for instance. If we look at wildfire, through satellite imagery, you can have a very clear understanding if it's burnt or not burnt, and you don't need to send loss adjusters on the ground to assess the damage. The technologies are getting better and better, so the scope of parametric insurance is growing as fast as the tech industry is growing. So it's the main driver behind. It was clearly not possible 10 or 15 years ago. And we expect more applications through Gen AI. This is something that will increase strongly. Now, if we look at the demand today, it's true that, for example, in North America, of course, there are plenty of corporate insurance, players looking for parametric insurance for hurricane and earthquake. But we see that severe convective storms and typically wildfire are becoming extremely popular. There are plenty of issues related to high storm, typically for solar farms. You can have like a solar farm destroyed, and it could cost like 75 million in 10 minutes. You have, of course, huge issues with wildfires, not only in California, but it is, of course, what we all have in mind. We have plenty of issues related to floods. So clearly, we think that the secondary perils that are becoming more and more painful, for example, for the US economy, will try to get insurance covered through innovative products. Mm-hmm. And parametric is clearly one of the drivers to protect populations and corporations.
And Sandra, like, how do we think about the application split between sort of primary insurance and parametric products being used as an alternative form of reinsurance? I mean, we don't know the exact numbers, but it'd be interesting to get your view on that.
It's growing. It's definitely a space where I think more and more reinsurance is necessary in order to continue that growth. So we are seeing huge spikes now of where insurance is willing to get into this space, take on some more of that risk, and then the reinsurance, and we're seeing the ILS space playing a big part of that. A lot of the traditional insurers, rated paper, may already be exposed in some of the areas for the Nat Cat space, and so it's crucial that we have more capacity coming into the market, and ILS space is good for that. It's in addition to the product being and parametric being very efficient in the way we can look at technology and how we can understand and define what the triggers are, it also removes a lot of basis risk. It removes certain things like the trapped capital is not as much of an issue because we already know exactly how much we would be paying out in the event that it would occur. So it's a very attractive product. Mm-hmm. Fast payouts. It's really about being there to help the insureds in need, and the ILS capital and the reinsurance can really help to fill that gap right now and see it grow mm-hmm. significantly.
And I'm going to ask you in the next question to sort of elaborate a little more on that. But before we move on, Boris, holding aside cat bonds for a second, speaking more about parametric insurance, thinking about the participation breakdown between traditional capacity providers and alternative capacity providers, specifically ILS funds. I mean, again, hard to know what that split is, but why isn't the ILS participation rate higher?
Yeah, I think we're just at the starting point of this development. Parametric risk transfers to the capital markets, the ILS funds. And from our perspective, we're very interested in parametric transactions because it resolves quite a number of problems we have, particularly in private ILS. So trapped collateral was mentioned. There shouldn't be any trapped collateral in parametric transactions. Then liquidity is important, so the liquidity is predictable of parametric transactions. We know after the event there is quite a fast payout, so we can give higher liquidity to our underlying investors into the fund. We don't have side pockets in these portfolios. Clients hate these side pockets. There is no valuation uncertainty. So a lot of advantages of these parametric transactions, and I think it's just a matter of time that more and more of these risks are transferred to the ILS market. And I think the ILS space is the natural home for parametric risks because of these advantages. And also the returns, the internal rate of returns are higher compared to an indemnity transaction because of the dilution of the trapped collateral on a traditional transaction, which we don't have on the parametric. So superior returns, better liquidity, and then also more granular in terms of exposure that reduces the tail risk in a portfolio. So all these advantages together makes it a very attractive opportunity for our clients.
Okay, and like let's talk about the value proposition. Like under what circumstances do parametric products offer superior value proposition versus traditional products? You know, think about it in terms of being both insurable and investable. Sandra, I'll go back to you. I mean, the motivations for a buyer, right? Like you have a very interesting wind product, talk a bit about for a minute or two. And then really when you're selling that, like what pain points are you seizing on that, you know, will help to sell a product that is parametric for a homeowner or for a community association or a commercial building versus just getting traditional insurance?
So Mythen insures the commercial SME space. And high net worth homes and condo associations. And what we offer is a deductible fill-in. So we're really providing that coverage where it is really needed in the market. We offer a capped, aggregate capped limit per year. And what that allows us to do is really maintain our exposure, really maintain what our capital that is required. We become very attractive because we know exactly how much we need to pay out. We pay out quickly. It limits, another benefit is it limits some of the social inflation. There's an incredible amount of social inflation that goes into looking at when claims adjusters go out and looking at losses and how long those losses get paid out over time in traditional indemnity policies. But with parametric and with our product offering and the capital that goes alongside it, it really helps to kind of control that social inflation on top of all the other benefits that we've just talked about.
Thank you. And Sandeep, I mean, you've been involved in the non-cat side really since the beginning days. For a protection buyer of non-cat, coverage, the focus can be, excuse me, income statement volatility, non-damage BI type applications. But it'd be interesting to discuss like the motivations there. Like, are there other alternatives in the non-cat space for somebody to buy traditional insurance, or are you sort of just pigeonholed into you have to use a parametric product for things like climate and weather? It'd be interesting to get your perspective on the buyer motivation there.
Sure. I think I just sort of go back to my original comment. I mean, with regard to what a parametric product is, it needs to be independent. If I'm an electric producer, I would like to have an index that's actually based on the amount of electricity I produce. That's the cleanest for me. But as a risk taker on the other side, it creates all kinds of conflicts of interest. I mean, how well do you run your operation? You control the amount of energy you generate. So if I could have an index which is very highly correlated with the risk that you're looking to protect against, it's a solution that works for both parties. And I think that's a key aspect of why some of these products can be applicable in the non-cat space, particularly in the energy sector, but also in a lot of these other products. And I know, Sandra, you touched on the basis risk a little bit. There's clearly a lot of work that needs to be done to minimize the basis risk and make this fit better. But when we really think about indemnity products, there's still a lot of basis risk. It's just that we don't realize that. The parametric products are typically, at least the way I think of them, is they're essentially covering a named peril product. a lot of the traditional products on the indemnity side. Again, some of them are named perils, but the majority of them actually are covering all perils. And so I think having the clients understand the difference between those two aspects is a key part to sort of grow this. And I think particularly on the non-cat parametric side, it's really important for the folks to understand what their exposure is, how comfortable they get with it. And at that point, the opportunity set is endless in terms of how you can structure a product, make sure the basis risk is minimized. But I think the key thing is that customers who are buying these products need to understand exactly what they're getting into and make sure that they're covering one specific peril. So.
Okay, and sorry, go ahead.
Yeah, just to add to that, I think what customers are really enjoying is the transparency related to the parametric product. So I think, you know, having that understanding of what exactly they get paid out up front is pretty important for them to feel comfortable, and seeing it actually pay out is also important.
And what I'd maybe even like to add there is in a lot of these cases, it's typically on the nat cat side, you have a big event, it can happen suddenly. You have an earthquake, it happens the previous day, you don't have any losses. A lot of these non-cat products, the risk evolves over time. So if you're a customer and you've bought a 6-month cover, by month 5, you pretty much know with a reasonable amount of certainty how much of a payout you expect to get. That's actually also helpful for the risk seller. No one likes to lose money, but if you know you have a loss upcoming, it's actually easier for you to actually plan around what the loss amount is, how you're going to fulfill that, and to have some certainty around it is actually very helpful, versus with a lot of the nat cat parametric products, given the nature of the risk, it can happen overnight, whether it's a hurricane, an earthquake, a wildfire. It's a very different kind of risk that you're sort of looking to hedge. But a lot of things, the one thing I'll add is a lot of these buyers are also looking, and I think Marty alluded to this earlier in the question, are looking to buy earnings protection. They're not necessarily looking to cover balance sheet protection, where it's an extreme event where if it happens, you might be out of business or you need to go and raise capital from equity markets. What they're really looking is there a way for me to manage my earnings volatility quarter by quarter? Because that would provide them a lot more value. And so I think a lot of these non-cat weather products, or parametric products, I should say, are actually looking at that earnings volatility management as opposed to capital management for an emergency event.
Mm-hmm. And on the parametric reinsurance side, I mean, you know, you sell interesting sort of broader geospatial type products, Tanguy. You know, it'd be interesting to understand how to use products like that for reinsurance purposes, somewhere where there's a geospatial consistency in the risk, whether that's a large area drought, large area wildfire, what have you. Be interesting to hear your view on the uptake of those products and the future of those products for reinsurance.
I think it has been around for quite some time, but following the 2023 renewals, during which some insurers struggled to find enough capacity, there was clearly more demand for parametric reinsurance products. Of course, it requires to model the portfolio. For example, if we look at a motor insurance player, we will need to have like the exact locations of the different exposures, so it's a bit more time consuming, but we're able to replicate quite accurately the potential losses following, for example, a severe convective storm. So this is something that is doable. It's not straightforward, but clearly doable. And we see that for insurers, they will benefit from the same product features as large corporations. So typically, if we look again at the LA fires, for some insurers, it will take years to have the full picture about how much they could get from their reinsurers, whereas for us, it's a matter of weeks. So clearly, the ability to get the capital very quickly is key. The ability also to, for example, cover the first layer. When we look at 2023, reinsurers try to increase the deductibles, so increase the retentions, of course, to increase the rates, which was clearly good, and clearly reduce the capacity available. So some insurers are trying to to cover the first layer. So basically, what may hurt their earnings, that may happen every 10, 15 years, through parametric reinsurance. So we are very optimistic about the growth of the market. Today, the Nat Cat reinsurance market is about 50 billion, and we expect parametric reinsurance to get a significant share of this market in the next 5 to 10 years.
Interesting. And one thing to note, and a good way of thinking about parametric products, is they are proxy products, right? So you have a second order hedge for a first order risk. And I think, Sandeep, you were alluding to this, like, people, a grower would love to index to the number of the oranges that fell off the tree on the ground. An electrical utility would love to have you protect the megawatts that they basically serve, right? So, hey, I don't really want the temperature product that's very highly correlated. I really want you to basically write me some sort of protection, upside or downside protection on actual megawatts. And that forces the seller of those products into taking on that basis risk. You're selling a first order hedge, but you're modeling it using second order type information, temperature or rainfall or freeze or what have you. And that's really where the basis risk emanates, right? It's the difference between, right, what's happening with the liability and what's happening with the asset. First order liability, second order asset, basis risk. So, as we think about that more, and Sandra, again, you're down on the ground with a product that really sort of competes side by side with a traditional indemnity product. Like, where do you see the future of sort of taking the product to sort of squeegee out all of that basis risk? Like, how do we go forward over the next 5 years and have even better products?
Well, our approach for the first year is really to play alongside the traditional insurance products as well. So we'll fill in that gap, and that allows us to kind of the deductible gap. And so we'll max out our exposure because we're not really insuring to the full limit of the loss or the property. And so, I really see that as more education gets into the market about this product, as more insurers really are looking for this type of product for them to look as an alternative, not a complete alternative, but maybe something that is supplemental with what they have, it'll continue to grow and grow. So I really think that it's here to stay, here to grow. More education is going to be in the market. The efficiencies of the product and the way we can sell and distribute our product, I think, is also a differentiator. So we utilize technology to allow us to do fast, immediate quote to bind, instant pricing, instant ability to make sure that we're getting into the hands of insureds who feel that stress and that strain of, hey, how am I going to fill in, the gap of their liability? And so we're utilizing technology, we're utilizing our ability to fill in where there are some stressed markets. Deductibles are increasing in the spaces that we're covering. So the traditional commercial property is, the deductibles are going up 5%, and so there is a gap there, and so we're filling that.
And just real quick on your wind product, like it's interesting people may not realize that there is both on-site wind collection and satellite wind estimation. For your wind speed product, where is the actual peril measured? Is it on the ground or is it satellite?
So we have a combination of the two. So we're using technology to assist us in multiple different ways, and we have one major trigger that we use. We have backup triggers as well. So it's really about maintaining a combination of information. We're an AI company, so we've been using generative AI from the very beginning. We're a startup, so we have a long journey ahead of us. But it's interesting how, really looking at these models now, how do the data that we're collecting work with the reinsurers, and how the education needs to happen, so how we can pass that information down to the reinsurers so they then feel comfortable. Technology is a little bit different, but I think it's educating the market and becoming comfortable with this type of risk and the efficiencies that this risk has, especially on capital. It's very capital efficient.
Mm-hmm. Or as you've been waiting patiently here, but the investor perspective now, you know, and Sandeep, I'll ask you to expand on that, or as his initial response. You know, how does the investor really think about the space? What's the value proposition? You mentioned a few of them, but there are a few others, right? Diversification being one of those versus other asset classes. It'd be great if you could expand on some of the things you mentioned earlier, maybe add a few things. You know, again, what makes this a superior value proposition from the standpoint of an ILS investor?
I think, as mentioned, talking about now the private ILS space, not the cat bond space, because parametric cat bonds have been around for a while. The World Bank cat bonds, it's a different segment. But on the private, I think the parametric transactions are, as I said, really superior to an indemnity in terms of returns. And the big issue we had since 2017, when it appeared, is trapped collateral. There are many solutions to it, right? You can do a lot of things, but ultimately you do not get rid of this problem of the trapped collateral. And parametric resolves this problem because there is no necessity of trapping. 24 hours, 2 days, 3 days after the event, you know whether you have a loss or you don't have a loss, and then it's clear. You don't have valuation uncertainty. That's another problem we face in the funds. You can value these transactions very quickly. You don't need side pockets. I mentioned this. Side pockets is something our clients hate. They don't like these side pockets, although it's a good instrument, but nobody wants this. And liquidity, from a fund perspective, now asset management perspective, is very important. That's why the cat bond market and the UCITS fund have grown so much, because they're liquid. But the parametric products, they have also a predictable liquidity. So we know when actually we get the money back or it's lost. So we can really match the underlying liquidity of the fund, the redemption terms, with the portfolio, and there is no liquidity mismatch. And that's very important from a fund construction and asset management perspective. So really we welcome what all these colleagues are doing here on the panel in terms of sourcing transaction, pricing them, and we would really like to get more opportunities to invest in our funds, because I think it's really a great offering that we can propose to our clients.
And thank you. And Sandeep, you know, Pier 61 is a newer fund. It's within a broader investment manager, alternative investment manager, Lighthouse. What was attractive about the space for Lighthouse? I mean, it'd be interesting to talk about diversification. One thing people don't talk about as far as sort of operational leverage in certainly non-cat products is the shorter tenors giving you multiple turns of capital within a year. Be interesting to have you expand on that a little bit.
Sure. No, and I think Urs covered all the key points why these products are significantly better as an investor relative to indemnity product. Maybe just taking a step back, as you asked, I mean, Pier 61 is a multi-strat fund. Reinsurance and ILS is one of the strategies. We also participate in a couple of other niche strategies or markets on the commodities and environmental market side. We're a startup within a broader, much larger alternative investment fund, Lighthouse Investment Partners, that has been active in alternative investment for the past 25 years. I think the key thing, as with most other funds here, is they sort of really value the diversification that these products bring in. Clearly, on the cat side, there's adequate returns in a lot of the peak perils, but when you sort of start looking at scaling the portfolio, you don't want to have a scenario where you have a big cat and you're down 40, 50%. That's a hard discussion to have with any investor. So to the extent, I think, as we all know, diversification is typically a friend in this space. And the benefit of some of these products is it allows you to diversify your risk a lot more in different perils and regions that you normally otherwise couldn't as easily access. But I think when you sort of look at these products and why investors get attracted to them, perhaps a lot is with regard to the amount you can customize your portfolio. Typically, you can look at cat bonds and you have ELs ranging perhaps anywhere from 0 to 5%, and you have multiples of that. Maybe you get 10 to 15% overall yield in the portfolio. With some of these products, as I mentioned earlier, they can be earnings products, so they have significant volatility. So you can structure a portfolio which actually yields you 20, 25%. I think as Urs mentioned, you have predictable cash flows on these. They tend to be very volatile, but if you structure this in an existing portfolio and you size it appropriately, it actually adds a lot of benefit to the actual portfolio outcomes. And I think you mentioned this too, Marty. I mean, I think we always like to say these products tend to be very short duration, ranging anywhere as long or as short as a couple of weeks or a month to typically 5-6 months, one season. So it allows you to recycle your capital. So you can effectively invest not just once, but you can invest it a couple of times in a year. And so I think that's very helpful in this. If you have a bad event, you can always make up for that by reinvesting your capital. So the velocity of your capital increases significantly, and that makes a big difference. And I think Urs pointed this out too. When you sort of look at the typical cat bond return, you're sort of dividing maybe by a time period that the duration of the bond covers, but your collateral could get trapped, and so you have to factor that in. With these products, maybe you have a payout, but you typically know when you'll get your cash back with little uncertainty. So having that ability to reinvest your capital multiple times is a big positive.
Mm-hmm. And I won't put Tanguy on the spot, but he's got probably the single best description of diversification and poison. I'll leave that for the cocktail hour, but definitely ask him about that. It's really good. So when we're looking at the market right now, and we're asking ourselves, like, what's required in order to scale, right? Like, we know now there is a value proposition for the protection buyer. We know there is a value proposition for the capacity provider, the investor. We know there's a value proposition for the intermediaries, basically to drive more volume and connect those two. Like, what is missing? Like, what do we need to scale the participation from ILS investors into the space? I'll start with you, Tanguy.
Yeah, thanks, Marty. I think it's a very good question that has been raised many times. I think we need to build a strong, resilient ecosystem with, of course, brokers being able to educate the market on the new product features and the new products that may be developed. In our case, for example, we have 150 data scientists, software engineers, DevOps, just focusing on understanding the consequences of climate change and building new products. So we need new products. We do, of course, investors and reinsurers that will make some money out of these types of covers. And of course, we see that a sharp increase in the frequency of some adverse events, hailstorms, floods, or some windstorms in some geographies. So we need fair prices, fair returns for the entire industry. And this is something that is not that easy. So we need to convince clients to pay the fair price. We need also to improve the economics. And I think ILS is a very efficient source of capital. If we just take a step back and if we look at the insurance industry, the expense ratio, for example, is around 30 to 35%. If we look at direct insurance players through, for example, the call centers or the web, it's more like 20%. For reinsurers, it's 5 to 10%. And clearly, if we look at ILS funds, sometimes they're able to offer like a much leaner capital source that is also a way to create this win-win ecosystem. So brokers, originators, clients that will feel the benefits of unique product features, of course, investors that will be satisfied. So this is a balance that is difficult to reach, but I think we're making lots of progress in that space. And again, I believe that new technologies will help to find this ecosystem.
Mm-hmm. So as we're winding down to sort of the last 5 minutes before we'll go to questions from the audience, you know, some provocative questions, thinking about the future. Looking at parametric net cat, which is, you know, it's a big market right now. Are those volumes going to hold up if the market softens? Is this really just a hard market phenomenon, or is this really here to stay? Sandra, I'll start with you.
I think it's here to stay. I think it's here to grow. I think as we keep educating the market, as you know, the value proposition is really understood, and you know the returns, you know, are seen, that it's going to continue to grow. I think we're only in the beginning stages of this. Mm-hmm. And you know, so there may have to be some adjustments as we go along, as the markets change, but I think it's here to stay.
Urs?
Yeah, I think we're just at the beginning of the development, and sometimes I'm comparing to the cat bonds, right? 15, 20 years ago, we had similar discussions. Is the cat bond market there to stay? Will it grow? And now we're at 50 billion plus, and it's an established asset class from the investor perspective. There were a few accidents in 2008-9, but it's a tested market. And I think we're at the same point now with parametric risk transfer to the ILS market, and it will grow because it's a value proposition. It makes economically sense to do that. As Sandeep mentioned, the big advantage is we can go into the frequency of the events with parametric, which we couldn't do on the private ILS indemnity because of the reasons we mentioned on the trapped collateral and all these problems. So it all makes sense. It's just a matter of development, supply and demand, and I'm pretty sure it will grow in a similar way that the cat bond market has grown over the last 20 years.
Mm-hmm. Tanguy?
Yeah, I think I'm quite confident that it's here to stay. It's also related to the losses in the nat cat market. So now we can all agree that it's about 150 billion per year. It was only 50 billion 15, 20 years ago. So there's a sharp increase in the insured losses, and it's even more the case for uninsured losses. So there is a growing protection gap. So I'm very confident that the insurers, the large corporate players, individuals buying insurance will keep on buying insurance. We don't see any reasons why they would switch back to, I would say, traditional, old-school products that have like lower product features.
For the last question here, sort of provocative, given that it's a panel of people who have started companies or funds dedicated to parametric products. But, you know, Sandeep, I'll start with you on this. I mean, climate and weather is a risk with a dedicated market, right? I mean, parametric execution is kind of what you have. There's no other way to do it. Nat cat's a risk with a dedicated market, right? But there's two ways to do it. You can do it with traditional indemnity products. You can do it with parametric products. Same thing with cyber, same thing with other sort of risks. Is parametrics, in quote, that's what people like to call it these days, is it a market? Or is it simply an alternative product to indemnity where the objective is just to manage a special type of risk? I mean, are we going to really need dedicated parametric specialists, or should we be more of generalists where we can look at a risk and say, look, I'm a portfolio manager or a structure of nat cat risk, and I can reach into my toolkit and use either one of these solutions, and I should be equally fluent in each of them to go out and try to solve the problem of the issuer or the protection buyer, and bring an investable product out. So, you know, how do you see that?
Sure. I mean, I'd like to sort of maybe frame the question a little differently in the sense, really, I don't think parametric products are a replacement for indemnity. I mean, sure, that might be the low-hanging fruit where you can say, look, I can't buy traditional indemnity, let me buy an equivalent parametric product. I mean, if we really think about it, and there's been a lot of discussion, I think even from Artemis in the past about the protection gap. I mean, it's huge. The insured loss was the economic loss. As we said, I mean, these products we all discussed are incredibly innovative. And if we can use them to really bridge that gap there we have in terms of the protection gap, the market can grow significantly more. So I don't really view parametric products as necessarily either competing or replacing an indemnity product. Sure, it might do in certain instances, but I think the use case is so much larger, and we've only tapped the surface on that. So really, I don't think we need to be a parametric specialist, but we really need to understand what the customer demand is, how can we have a better product, a solution for them, and that really needs to be the focus. And many times it is a parametric product, sometimes it's not, but I think really the way to grow the market is to really focus on what the end solution that is seamless to a customer. I know, Sandra, obviously you guys are doing a lot of work, and the market collectively has tried to reduce basis risk, but it just needs to be a simple, easy product that whether it's a retail customer or another type of investor that they, risk hedger, that they can sort of look at this and say, yes, it makes sense to me, I'll do this, and it has to be simple. So I think there's a lot of scope for growth in this market. I wouldn't say you need to be a parametric specialist. You need to be focused on the customer and maybe a product specialist or a vertical specialist.
Okay. I feel like a news anchor. Tanguy, last word, 20 seconds.
So for me, parametrics is a means, not an end. So basically, it's a way to modernize insurance products and modernize the insurance industry, because again, value proposition is not really good, and we need to do something against that. I would not be surprised if all insurance products become parametric in 30 years. Again, because we can't expect clients to wait for 550 days. That's the case in the US for the corporate segment, between the declaration of loss and the claim payment. So clearly, it's just the new trend. It will take maybe 30 years. It will take maybe 20 years. But I think there is we can't stay in this situation. It's just not possible for the insurers and for the insurance industry.
Mm-hmm. Great. So we have a couple of minutes sort of for questions. Yes, sir.
Yeah, a couple of questions on this. Very interesting. Thank you. I may not need it, but a lot of other people might. Way back in the mid-'90s when I was writing academic dissertation on the emerging cat bond market, one of the things we were talking about that was interesting from an academic perspective, but I'm not so sure it was interesting from an industry perspective, was parametric as a control for moral hazard in underwriting. I'm wondering if that's really developed in the industry. And the second is there was a brief mention on contracting as derivative as opposed to insurance, and I'm wondering how much of that is related to FAS 133 or other accounting considerations. Thanks.
I can take the first question, sure. Actually two. Clearly, from the insurer standpoint, it's clear that parametric insurance helps to fix moral hazard and anti-selection. So it remains, I think, one of the advantages for large insurers, clearly. And it won't change. For the second part of the question, maybe also.
On the legal contracts, there is still a lot of work to be done, right, on trigger definition and all these type of things, but that develops alongside with the market, and the bigger the market is, the more resources will be invested in these legal issues, and that's where the market has also to be tested in some of the transactions going forward, and I'm pretty sure there will be accidents, but that's part of the evolution of this market segment within ILS.
Yeah. Another question? There's one in the back. One right here, too. Sorry, Alex. Give it a sec.
Can I go?
Adam.
Sure. So I've always looked at the parametric market as being limited by solely, buyers in the energy space. And recently, New York State licensed, or I guess approved, parametric as a insurable class of insurance. Do you think parametric actually has a real opportunity, unless it gets into the personal line space, to deal with increased costs, impacts on underlying valuations? And if it doesn't go there, does it stay restrained by volatile buyers or protection?
I can take it. Well, clearly, we see that the penetration rate of parametric insurance is higher for large corporations, or for, I would say, large SMEs. There are more and more applications for, I would say, personal lines. Of course, we need the right data sources, and we need, again, the right algorithm, so it will take more time to offer appealing products to personal lines. There are many examples, like flight delays, for example. You know exactly when a plane would land in a specific airport in the US. So there are ways to make sure that the data are bulletproof. But of course, it will be a long and painful process to get it approved for all regulators. Whereas in the corporate segment, it's more global market with relatively standard wording. So it's I would say, the low-hanging fruit when we compare different segments. But we see more and more regulators in Europe, in Asia, in North America, promoting parametric insurance as a way to secure either more capital or, again, a better customer experience.
Yeah, I'd add one thing to that, Adam. I mean, I think that's a really great question. And, there are a lot of sort of personal line type opportunities as you drive down to the consumer. I mean, one of those is in energy, right? Cold winters and hot summers, like the ability to cap usage costs in your energy bill. It's been attempted in a very simple way, probably 20, 25 years ago. But that's real value added, especially as energy costs are going up. Weather volatility is going up. The ability to go to a consumer and say, look, we've capped your usage. If it's hotter on average in the summer than, 85 degrees or something like that, we're going to start to give you some bill relief. Same thing in the winter. So that's one opportunity. And another one that I think everybody should be aware of is that Many state OSHA offices now have actually standardized workplace condition type rules where you literally have a weather derivative sitting inside of a collective bargaining contract or state OSHA rules where you're like, look, if it's greater than 95 degrees, we're done for the day. We saw that with Dutch construction frost days where the union basically said there's a lot of little triggers, but if it's basically freezing at 7 a.m. in the morning, the workers get waylaid, they go home, you still pay them, right? So I think there's a lot of opportunities now with data, with computing, but we really need the ability to aggregate up, and I think these sort of sovereign state and local governments even are great ways to do that as basically distributors of that risk. So one last question I think we have time for, Alex?
Okay. I'll make it quick. Alex Gore, Parametric Consulting. Folks, I think it's very important to emphasize at least 4 other aspects of parametric insurance beyond the fast payments and transparency, which are very important. I think the one that is being played out right now in LA is flexibility on use of funds, which means that anybody who is lucky to have insurances have to make a painful decision right now, whether to take smaller amount of payout from insurance and go elsewhere or to rebuild. Parametric does not have that. You can take the money, it's a flexibility, and there are no strings attached. Another example, often in a consumer, you hear it, especially Florida, California, how do you incorporate mitigation discounts, right? You harden your house and whatnot, how does it get reflected in discounts? Well, with parametrics, it is eminently suitable because if your house is built to the codes, maybe you take out a wind policy attaching at category 4 as opposed to the house of your neighbor, which attaches at category 1 because it was built 30 years ago. Last but not least, again, in Florida, because there is no claim settlement as we know it, all the massive litigation, let's say, not to pick on Florida, but let's pick on them, it basically goes away. And all the contribution to loss adjustment expenses. So just if you think of it for a moment, if the hurricane exposure in Florida was carved out of the personal lines policies and hedged instead parametrically alongside, just what a tremendous savings that would be, right? So parametric would be the worst enemy of unscrupulous roofing contractors in Florida. Lastly, parametrics are uniquely suited to the really emerging breed of solutions called predictive parametrics, also known as a forecast-based parametrics, also known as anticipatory action. Examples with the World Food Program, with the Philippines, etc. It's an incredibly powerful market. I agree with Sandra, it is here to stay. New York State with the legislation, it's a nonsense, so don't worry about that stuff. But anyways, thank you.
Okay.
So to your question.
Yeah, absolutely. Steve, do we have time for one more? Or? No, I think we just got the Academy Award music playing in the background. Get off the stage. So listen, I want to thank our great panelists today and Steve Evans for the opportunity. Thank you.